Hi, everyone. Good afternoon. Why don't we get started? I'm Whitney Tilson, and my partner Glenn Tung will introduce himself momentarily. This webinar we're doing is focused on the fundraising process for hedge funds and other types of investment funds, something we spent 20 years doing with some success, not as much success as we should have, as you'll see in a moment. But let's skip to the first slide. And the agenda we have today is Glenn and I are going to introduce ourselves and give a quick intro how this webinar fits in with what we're trying to do here at Kase Learning, and then turn to the topic of today's webinar, the fundraising process, talk about the opportunity we had that we partially seized, but could have seized to a much greater degree, the things we did right, but also the things we did wrong. And then just walk you through the highlights of what an effective sales process looks like for raising capital for a fund. So let's just start with, let me introduce myself. Here's some pictures, just going way back to my youth. My parents met and married in the Peace Corps. I grew up in developing countries around the world, starting in Tanzania, where I first went to school. I wanted to be a farmer like all of my other classmates. So you see me in the upper left-hand corner with my hoe. I moved to California. My dad was doing graduate work at Stanford. I was one of the 600 kids in the famous marshmallow test. That's not a picture of me, but one of another kid agonizing over whether to eat the marshmallow. Spent 3 years in Nicaragua, moved back to the United States, lived in Western Massachusetts, Boston, went to Harvard and Harvard Business School, worked a couple years at Boston Consulting Group and started Teach for America in between. Met my wife when Bill Ackman and I crashed the Harvard Law School orientation booze cruise of Boston Harbor. Got married. We're approaching our 25th anniversary, October of this year. And we now have 3 wonderful daughters, one whom just graduated from college, one who's just finished her freshman year, and one finished 10th grade. So as far as the business goes, after business school in 1994, I spent 5 years working with Professor Michael Porter on a nonprofit initiative and got the investing bug in that period. It was the late 90s. In hindsight, I was a bit of a late 90s bull market genius, but decided to hang out my shingle as the world's smallest hedge fund on January 1st of 99 with $1.1 million under management. And built it from there, as I'll walk you through in a bit. But before I go on through this presentation, just wanted to ask Glenn to introduce himself.
Good afternoon. Hi, I'm Glenn Tung. I did not have as diverse a background, a childhood as Whitney. I grew up in West Orange, New Jersey, went to college at Princeton, where I studied electrical engineering and computer science. I worked in my dad's business, which is called Blonder Tongue Laboratories, and they made pay TV equipment, electronics for cable television. I actually worked there since I was about 10 years old. So that was where I was going to make my career. I went to Wharton and got my MBA. And then after that, my dad sold his company, so I went to work on Wall Street. I became a managing director at DLJ, a pretty active investment bank back in the 90s. At the end of 1999, I moved from Donaldson, Lufkin, Jenrette proper over to DLJ Direct, an online brokerage firm, and I was the president of that firm through the point where DLJ got sold to Credit Suisse, and they didn't want that business, and we sold that. I moved over to UBS for a couple of years, but when I was at DLJ Direct, I got the investing bug. I got to know Whitney very, very well. And decided to join him in the hedge fund business. Worked with him for 8 years there. Ran some money after that period for a couple of years, and now am the president of Kase Learning, working with Whitney with this business. So with that,
thanks, Glenn. Before we dive into the slides, let me just encourage everyone. We're going to present for maybe a little more than half an hour, but we've got more time, and so how much longer we stay will depend on the questions we get from you. So there is a Q&A button. There's both a Q&A button and a chat button. Don't use the hand raising button because there's so many people on this call we're not going to be able to make the participants live to ask their questions directly. So what we encourage you to do is press the Q&A button and just type your question in there as we go along. Glenn's right next to me here, and he's going to be reviewing that if you can also use the chat feature as well if you just have any comments or you prefer to use that. So you can ask us questions either way. It's a little bit logistically better if you use the Q&A feature. So let me, so you don't have to wait until we're finished with the presentation. Just go ahead and start shooting questions via the Q&A or the chat, and we'll get to them when we're finished with the presentation. So let me just run you quickly, very quickly, just a little bit about Kase Learning, and just to give you a little context or framework for this. I closed my fund after almost 20 years last fall. Very quickly decided that there was both a market opportunity and something that I love to do, teaching investing and hedge fund entrepreneurship to the next generation. So created Kase Learning, invited Glenn to join me, and we're off to the races. Our goal is very simple. We're trying to help other people achieve the success that we had for many, many years, and also avoid some of the pitfalls that we encountered. This is an apprenticeship and experience-based business, and we've got a lot of experience to share. And we don't think there's really anybody else out there doing quite what we're doing. And we've been doing it for 6 or 7 months now, getting a great response, and are about to take this on the road. So this slide, we're going to be visiting 10 cities in the next 10 months or so, as well as doing it a few times in New York. So we're going all around the world. This slide presentation, I will send you the PDF to this, to everyone who registered for the webinar, so you don't need to be frantically taking screenshots or notes here. We're happy to send this to you. But just a couple highlights of what we're all about is investing is really, really hard. This long bull market has been hard on value investors. It's a battle out there trying to generate performance. It's hard. You got to be really good, and we're trying to help our students become better at this craft. We teach almost entirely based on real-world case studies, actual companies we owned or were short, actual case studies of our own experiences. There's no theory in what we teach. We don't just teach our successes, but we're very honest about our mistakes, because often the best learning comes from avoiding other people's mistakes. We think we're value investors, but we're really make money investors. So we're not traditional hidebound, just buying things at cheap multiples. We have found value in things like Netflix, Google, and Facebook over time. We're also not just teaching investing, but we're teaching entrepreneurship for people who actually want to start their own businesses, managing money like we did, and want to grow them. So our 3 core programs we teach over 5 days. It's sort of a 3+1+1 is what we call Lessons from the Trenches Investing Boot Camp for 3 days. And then there are 2 optional add-ons. Most people take it as a 5-day program. The first add-on is how to launch and build an investment fund. And this webinar today is part of what we teach there, specifically focused on how to raise money. But it's all the logistics of how you start a fund, should you start a fund, and then, how to do everything, not just raising money, but hiring people, writing great investor letters, putting together a great investor pitch deck, managing through periods of poor performance. It's everything not about putting up numbers. It assumes you can put up good numbers. Now it's how do you convert that into a business? And our last day is an advanced seminar on short selling, which is we're going to give a little overview of that tomorrow. At our second webinar. Same time, if you're interested, you can register for that as well. So let's skip now to how to raise $1 billion or not. So this was our performance for the first 10.5 years. We nearly tripled our investors' money in a flat market. And survived 2 of the greatest downturns in stock market history, the bursting of the internet bubble and the housing bubble. So we were riding high. In hindsight, we should have raised a lot more than we did. We grew from 1 fund and about $1 million under management at inception to 3 hedge funds, 2 mutual funds, and approaching $200 million under management. And when I look back at that period, I thought I had died and gone to heaven, growing from 1 million to 200 million, little guy operating out of his bedroom for the first 5 years or so. And so money seemed to be coming in every month, and I thought everything was going great. It is only with hindsight that I look back and realize that in light of that great performance, that there was the opportunity to raise $500 million of good money, or $1 billion of somewhat less good money. Had I had an organized, well-executed fundraising process, and had really thought that out, and I didn't. And that means in the first 10 and a half years, this is a business when the sun is shining, you got to make hay, and I didn't make nearly as much hay as I should have. And so what I want to cover in this webinar is just the highlights of what we cover in great depth at our full day seminar, of what some of the lessons were. And growing from 1 million to 200 million was quite an achievement. Very, very, very few people start in this business with no experience. I didn't spend a day in the hedge fund or anywhere in the investing or even financial world, and successfully grow that to as big as 200 million. But still, there was I made a lot of mistakes in not seizing the full opportunity that presented itself, and could have done a lot better. So let me walk you through a little bit of this. So what are the things you want to emulate that we did well? Obviously, we put up good numbers. You saw that 2 slides ago, but it's not good enough. By definition, there are 8,000 funds out there. By definition, 800 of them have top 10% numbers, right? Mathematically. So the question is you got to have good numbers, but then you also have to go out there and sort of make a name for yourself and get noticed. And we did a good job at that. We wrote, I would like to think, very compelling investor letters. We distributed them widely. I picked up a writing gig at the Motley Fool initially, and then at various other places. I was a CNBC contributor, was on 60 Minutes twice. So went out there and became fairly well known, and built a good name, good reputation, I'd like to think. I also built big email lists and communicated with people that way. Showed up at the Berkshire and Wesco meetings, transcribed those, transcribed the Buffett partnership letters, a bunch of Munger's speeches, and really focused in 2 areas where we did a deep dive. One was into the internet bubble, into subsequent bursting, and very publicly called that a bubble, and was vindicated on that. And then similarly with a number of years later with the housing bubble. So we did a lot of things right, not just putting up good numbers, but going out there and making a name for ourselves and getting noticed. And that's what translated into assets growing from $1 million to $200 million. So what were the mistakes? What was the missed opportunity? And we never, I've said earlier, we should have gotten to 500 million to $1 billion, not 200 million. That was the missed opportunity. And why didn't we achieve it? We never hired a marketing person internally or a third-party marketer. We were very good at responding to inquiries, but didn't do any follow-up. People would email us. We'd inquiring about investing with us. We'd send them our materials, and then waited for the money to come in. And of course, that's not the sales process. We didn't follow up, and we didn't ask for the sale very well. There's a whole process that I'm about to walk you through. And we got the initial part of that process right, which is putting up good numbers, and going out in the world and becoming known and generating a lot of inquiries. Where we completely fell down was the whole follow-up process from that point. So let me walk you through that process. It's a 6-step process, and I'm just going to give you the highlights. We go into a lot of depth on this when we've got a full day to teach for folks coming to our seminar. But so let me give you the highlights, and we can dive into any parts you want during the Q&A. So number 1, you have to have the right mindset, namely of extreme confidence. If you don't believe that you're a super talented investor who's highly likely to deliver great adjusted returns over time, which, by the way, does not necessarily mean beating the S&P 500. You may be focused on a more low volatility, absolute return strategy that protects the downside. That's okay. But whatever strategy you are bringing to market, you have to have a high degree of confidence that you are really good at this and are going to do great for your investors. And if you don't have that confidence, what the hell are you doing running money? So given that you do believe this, you got to believe that anyone who invests with you is going to do great, be very, very happy. And therefore, you're doing them a favor by bringing them this great investment opportunity to invest with you. So you got to have that confidence as a starting point. Number two is this process requires a focused, big effort. And it's tough if you're out there actually focused. You're an investor. You're trying to put up good returns, and that requires an enormous amount of research, et cetera, to then simultaneously be able to go out there and be a salesperson and spend time cultivating prospective investors and closing the deal and so forth. One, it's a very different skill set than being a good investor. Some people can do both well, other people don't. But even if you do have both skill sets, trying to do it all by yourself, once you get to be any size, north of $10 million, is difficult for anyone to manage. So, my recommendation is do something like what my friend Sam Madrangi of Carisdale Capital did, which is as soon as he got to 15 million, he hired a marketing person. And as he grew, he hired more than one marketing person. He hired third-party marketers so that he could focus on investing, and he could really tap into the fact he put up some really great numbers, nailed the China frauds earlier this decade. And he grew from 300,000 to 500 million in a matter of a few years. That's the way to do it. We never made that investment, even when we got to 200 million, much less 15 million. So obviously, when you're growing, you want to be careful of hot money. And so maybe you want to take a little bit less money and have a more stable base of capital. That's cool. Depends on a lot of factors, what's right for you. But the message here is don't try and do it all yourself. You have no choice but to do it all yourself when you're super small. But as soon as you get much above 10 or 15 million, start to think about bringing in at least sort of more of an admin follow-up person. And then as you grow further, someone who's more senior, because you can afford that kind of person once you're a little bigger, and you can go after institutional money. So number three, you got to generate prospects. So mathematically, how much you raise is a function of just three things: how many prospects you pitch to, times your conversion rate, times the amount of money the average person invests. So let's take a deep dive into each of those. So, the first two are your batting average. The third is your slugging percentage. So you need to figure out how to generate prospects, people who are interested in hearing your pitch. Initially, that may be, it's anyone you either send your pitch deck to, or mail, or in person pitch somebody. That would be considered a shot on goal, a pitch to a prospect. I'm not going to dive into the weeds right now about the dozens of things I did over the years to generate prospects. But this was actually something we were pretty good at. But we never tracked it. And one of the things you need to do is track it closely. And if you're going to raise money, you should be aiming for, pitching on average one prospect a day, and check in at the end of every week. Did you pitch 5 prospects that week? Did you pitch 20 prospects that month? 200 a year. If you're going to, it's really important. It's easy to track, and you need to track it. Okay, so now you've pitched to a prospect. Obviously, you're going to raise an awful lot more money the higher your conversion rate is. So the most important thing to converting people from prospects to investors is a good track record, that you've been delivering on and putting up good numbers, delivering on what you've promised to do. But keep in mind, investors aren't just looking for big returns. First and foremost, most investors are looking for safety first. Secondly, high returns. And third, a real important factor here of your conversion rate is just likability. Do people like and trust you? So you need to become a great salesperson, build relationships, persuade people to like you and think you're super smart and talented, and then you got to ask for the sale. So the more in person you can do, the better. So you're much more likely to have a good conversion rate if you meet with people in person. Second best is over the phone. Third best is via email. And one of the tips I found that worked well is whenever you do get a meeting with somebody, talk to them about at least a couple, if not 3 or 4, of your favorite stock ideas right then. Bill Ackman told me when he was first starting, trying to raise $3 million back in 1993, I believe it was, that he went into every meeting, pitched 4 stock ideas, and he was stuck at $2 million. And he and his partner decided they weren't going to launch until they got to $3 million. And he said, we were helped out by the fact that during this process, there's a couple-month process of the 4 stocks he'd been pitching from the beginning of the process, one of them doubled and a bunch of them, a number of them went up a lot. And that helped establish credibility. And sure enough, they raised the last $1 million and we're off to the races. Also, keep in mind that sometimes the conversion rate, there's a short-term conversion rate and a long-term conversion rate. So some people may not be ready to invest with you now. They may not have the capital free. They may want to see some more results and returns from you. So you need to keep track of people, even if you don't get an immediate yes from them. Continue sending them your investor letters. Anytime you're quoted in a newspaper article, publish an article of your own. Anything that would be of interest to a prospective investor, sort of keeping them informed and following up. And I can't tell you how many people who, I sent them my materials, had a conversation with them. For whatever reason, they chose not to invest. And then a couple years later, I'd put them on my email list. They were getting my monthly or quarterly letters for a couple of years. And they would just reach out of the blue and said, "Hey, Whitney, I've been following you for a couple of years. And I just sold my company. Or I just got an inheritance or something like that. Can I invest with you now?" You got to work that as well. Sending out your monthly or quarterly letters to a broad group of people. You're not going to get a high conversion rate from that, but you can very efficiently reach hundreds or even thousands of people at a time. The key here, though, is you need to increase your conversion rate. You need to have a well-organized process with very professional materials as a starting point. So you need to hire whatever support you need or set up a system to follow up with people. And you need very polished professional materials. You can't go to market with an investor pitch deck that looks like you created it. You need to create it and then send it to a graphics person to really make it shine, make it look super professional, even if you're real small. So number 5, once you've converted people, you'd ideally like them to invest $1 million, not $100,000. So obviously, to increase the amount people invest, you want to focus on people who have the capacity to write large checks. Generally, you're going to get 80% of your money from 20% of your investors. So that's a key starting point, and that's where you want to focus your attention on people who can write larger checks. And then during the whole process, you don't just want to focus on big numbers, but on conservatism, risk management, the message being it's safe to invest a lot of their capital with you. And then, I generally had $1 million investment minimum in my documents. I was willing to waive that pretty regularly. It's not a legally binding thing, but you want to anchor people high. So have a reasonably high number and then say, okay, I'm willing to start you at $250,000 or $500,000, right? But ask for a high amount. So lastly, how do you keep investors once they're in? So obviously you want a lot of new investors coming in, existing investors adding to their investment, but you want to reduce the outflow. So again, obviously, generating good returns is what's going to keep your investors happy and staying with you. For institutional investors, this is probably 90% of the game. For individual investors, though, not as much. Individual investors tend to be much stickier money. It's easier to develop personal relationships with people. So it's not as critical putting up big numbers every year to keep your individual investors with you. So what are some other things you can do other than generate good returns, which is most important? Number one is write really good investor letters. I always wrote monthly, not quarterly. There's just a regular opportunity to keep in touch with my investors. It was something they could forward to their friends. It was a little reminder, hey, I'm out here working hard for you, putting up good numbers for you. They might add to their investment. It can cause short-term thinking. When you're not putting up good numbers, having to write a monthly letter to your investors is just something you're sort of dreading at the end of every month. Wouldn't it be much easier to write a quarterly letter? But let's assume you're putting up good numbers and you want to get your name out there as regularly as possible, both to your existing investors, but all the prospective investors who you can send your letters to. So I wrote monthly. In addition to writing to your investors, just reach out to as many of your investors as you can, as often as you can. Cultivate personal relationships. Get them comfortable with you, with your investing style. If you're a concentrated investor taking big positions and therefore your returns are going to be volatile, communicate that to them and get people comfortable. Don't be a black box. Talk about the stocks that you own. And so offer transparency, which is something that really shouldn't matter that much to you, but is very highly valued by investors. We, for a while, hosted quarterly conference calls. We hosted 1 or 2 annual investor meetings. So we took every opportunity to connect in a positive way with our investors on a regular basis. Obviously, being just nice and likable and pleasant to deal with helps a lot. We always gave investors our personal cell phone numbers. I don't think anyone ever called it, but the fact that we offered it, they appreciated it. And then when you go through periods of poor performance, your natural instinct is to go sort of hide under your desk. You're sort of embarrassed. Maybe you've lost your investors' money. And you've got to resist that urge and make a special effort to go out there and communicate with your investors. They're sort of expecting you to be hiding in a bunker and are pleasantly surprised if you're calling them up or having a conference call to discuss why the fund's returns have been poor this year, that kind of thing. So that's the end of the sort of half-hour prepared presentation. And Glenn's been keeping track of a lot of questions that have come in. And I encourage you to just press the Q&A button on your screen, and you can ask your own question, and we'll try to get to all of them, try to process them fairly efficiently. So how do you counter? So you're out there, it's a great question, which is hedge funds have very high fees. They, as an asset class, have underperformed by a wide margin during this long bull market. And not just Buffett, but a lot of smart folks out there are saying, abandon all active money management altogether, or at the very least, abandon all high fee, hedge fund money management. So how do you counter that? Well, answer number one is put up numbers that beat the passive indexes, and there are quite a few folks who've done so. And that's the simplest way, which is say, look, what you care about is not the fees. What you care about is the returns and how much money you're making. And here's how I've done. So that's the most important answer. Secondly, look, I managed almost all of my parents' retirement money for the 20 years. I still do. They have retired in Kenya. They lived in Ethiopia for 8 years during this period. So, and I put, I think I had sort of a third of their assets in cash, bonds, real estate, etc. They own 2 homes in Kenya. Secondly, I had about a third of their money with me, and I had a third of their money indexed. So one way to raise money in a world of indexing is to acknowledge that indexing is a great option, and that's where someone should have the majority of their assets, in fact, or their equity assets anyway. And just say, look, but with a portion of your money, 20, 30% of your money, try and beat the market, or that could be number one if that's your objective as an investor. Or number two, the problem with an index fund is if the market's down 20%, your index fund is down 20%. And I manage money in a way where I have a short book, I have cash, I have stocks that I think will perform better in a down market, maybe talk about something like Berkshire Hathaway. And so you can position yourself either, depending on what your investment strategy is, as something that has a shot at outperforming the markets, and hopefully you have a track record that shows that, and or obviously best if you can offer both, which is downside protection. Because I think a lot of smart investors today are rightly almost 10 years into this bull market, are starting to think about what happens when the next recession hits, when the next downturn hits. So those would be my selling points, depending on what kind of strategy I was running.
So there's a couple of questions on fees. And so let me characterize them simply as, what was your fee structure?
Mm-hmm.
What is a fair fee structure? And along those lines, doesn't growing your fund in terms of assets result in lower returns?
Yeah, a lot of good questions in there. If you're setting up a hedge fund, if you're doing separately managed accounts or something, that's probably a different conversation. But assuming you're setting up a hedge fund, private partnership, the industry standard today, it varies a little bit on the management fee, but I would call it 1.5% management fee and then 20% promote. So the shorthand for the industry would be 1 and 20 or 1.5 and 20. Some people are even 2 and 20. My experience is that every young person starting up their own fund wants to do something creative, clever, something they feel is more fair to investors. So they put in a hurdle. They charge no management fee, that kind of thing. And a popular one among value investors is 0%, and then you get 25% of everything above 6%, which is the classic Buffett partnership model. My suggestion is that you take a management fee. I think in the early days, certainly, no one is going to not invest with you if you charge a 1.5% fee versus a 1% fee. So charge the 1.5%. If I'm an LP in an emerging fund, I want that manager to get a 1.5% management fee so that they can pay their bills of their business and cover their living expenses, so they don't feel like they need to go out and take a lot of risk with the fund and with my capital, right? So the management fee, by the way, after 50 million or 100 million, it would be fine to scale it down to 1.25% and then down to 1%, let's say. That would be a reasonable thing to offer. But when you're small, a 1.5% management fee on a $10 million fund is only $150,000 a year. That if you're running a very lean operation, maybe that covers your operating expenses of your business, but doesn't leave a lot left over to pay your rent and your kids' school and all your living expenses. So I would not be embarrassed about taking the management fee. In terms of the promote, it's pretty standard across the industry, 20%. I have seen founders class at 15%, but my general advice is don't get cute. The problem is if you're not just a standard 1.5 and 20 that everyone is accustomed to, you're going to spend half of every call with a prospective investor trying to explain why you're 0 and 25 above 6%, or why you're taking something relative to the S&P 500, et cetera, et cetera. And that's not what you want to spend your investor meetings on. So just acknowledge if you're starting up a hedge fund and you're charging hedge fund fees, those are high fees. But don't try and do something cute that draws attention to those high fees. And where you waste half your time with prospective investors trying to explain your cute solution and why it's somehow better for them. You're just shooting yourself in the foot for no reason, in my view. So the thing you should be focused on is making sure that you deliver performance to investors after your high fees that makes them happy.
So we got 2 questions regarding fund startups that I think are great questions. One is, how do you get over the initial hurdle of the cost to start up an investment fund? And the second is, does one's personal investing count as a track record for starting a new fund?
Yeah. Well, look, it's not that expensive to start a fund. You're probably doing it with a first-class law firm like the one we've used for almost 2 decades, Sadis and Goldberg here in New York, that does an awful lot of funds, have a lot of experience. Even with the registration and filing fees, plus the legal costs, is probably around $40,000. Now, that may sound like a lot of money to some of you, but if you're starting a business and you're going to go out and try and raise millions of dollars, that's not a big check. And by the way, if you're starting a small fund, you're going to be going without a salary. The main cost of starting your fund is the opportunity cost of you not having a job. And that's probably hundreds of thousands of dollars over the first few years until you can build your business up. So getting hung up on the $40,000 to start a fund doesn't make any sense to me. But secondly, the startup expenses of a fund are an expense of the fund. Those are totally legitimate, and it'll be in your documents that you charge that to the fund. Now, I wouldn't suggest charging $40,000 of startup costs to a $100,000 fund. What you can do is you can just put in the documents that over the fund's first 5 years or 3 years, those costs are prorated. So certain expenses of the fund, for example, the annual audit, the trading costs, those are expenses of the fund and shared by all of the fund's investors, not straight out of your pocket. What was the second part of that question, Glenn?
Does your personal investing track record count?
Yeah, well, that's a great question. A separate question, which is, okay, so you're going out to market, you're trying to raise some money, manage other people's money, and you've never managed money professionally. This is the first time you're starting a fund. So what are you marketing? And of course, the answer is your personal track record. And yes, you should market the hell out of it. Now, you just have to, when you put up a performance chart, when you list the stocks and so forth, you need to disclose, of course, that this was a personal account and that it's unaudited. Don't bother going out and getting your E-Trade account audited. It's your personal account. Everybody knows that. Just disclose it. But it was real money. And, I started in this business managing some of my own money. And then my parents who were overseas, put, $100,000 or something in an E-Trade account for me back in the late 90s. And whatever stocks I bought in my own account, I bought for their account as well. And that's sort of how I got into the business, without creating a fund, without setting up any legal documents or anything. My parents just gave me the password to their E-Trade account, and I just did in their account what I was doing in my own account. Be very careful, though. Don't do this with outside money. You can only do this with immediate family. I wouldn't even go to friends for something like that. You're exposing yourself to too much risk if you're managing those friends. If you lose them money, may not be friends and may sue you, whereas your parents probably aren't going to sue you. Yeah, other questions, Glenn?
Yeah, I also think that it's really important that you disclose exactly what you're disclosing. You define what you're disclosing clearly. You're not trying to pull something over on someone, but you're putting whatever you have in its best light. So thoughts on SMA, which is separately managed accounts, versus fund structure?
Yeah. I used to always feel like separately managed accounts was something that you would start initially with a few separately managed accounts, maybe even informally, like I just described with my parents' accounts. But then as soon as possible, you'd start a fund and consolidate those investors into a fund. And I generally think that's probably right for most people. That said, I've now met a number of people who run really good separately managed accounts business, and the arguments they make in favor of that are that investors like it more, so you can raise more money and they will put more money into a separately managed account than they will into a fund. Either they won't invest in the fund or they'll invest a smaller amount relative to offering them a separately managed account. Because a separately managed account is a lot better from an investor perspective for a number of reasons. One is they have transparency and they like seeing what you're doing with their capital. Number two, from a tax perspective, makes it much simpler. They are not buying into any embedded gains or losses that could then be realized after they invest in the fund. And also you can negotiate different fee and different redemption terms with certain investors via separately managed accounts. So it's quite favorable. And if I were an LP investor, I would prefer to have a separately managed account with someone. So taking advantage of that, and you can use good software now that if you make a decision to buy Berkshire Hathaway and make it a 5% position, there's software that can just allocate that over all of your separately managed accounts. So I no longer have nearly as strong a feeling that you should absolutely definitely try and create a fund. I'm open to the idea that for certain types of investors, particularly if you're a long-only investor, it gets a little harder to run SMAs if you're doing shorting or have sort of a complex, heavy trading investment strategy. But if you're mostly just a stock picker, picking 10 to 20 stocks, long only, you can build a good business with an SMA.
So there's two questions that are similar here, having to do with marketing. The first is, how do you market a concentrated fund strategy, given that investor concern number one is safety? Mm-hmm. And number two, how do you market an absolute performance manager to a benchmark-oriented consultant?
Yeah, so those are sort of two different types of strategies. So let's address the first one, which is if you're running a 10 stock or 12 stock portfolio, or even half that, you're going to be volatile. And how do you handle that? Well, partly the answer is it depends, because if you've got 50% of your portfolio in something like Berkshire Hathaway, well, it's not going to be nearly as volatile or as risky, right? So concentration does not necessarily mean volatility, though obviously there will be more volatility generally with a more concentrated portfolio, and does not necessarily mean you're taking huge risks. It depends on what stocks you own. But look, my general sense is if you're real small, and you're trying to grow, you can't just be plus or minus the index by 1 or 2 percentage points. You need to do something to differentiate yourself a little, and that means taking one or two very calculated big bets. In the early days of my fund, 15 months in, at the very peak of the internet bubble, Berkshire Hathaway was getting killed. I had been buying it, and it was a 10% position in my fund right at inception on January 1st of 99. And the stock price then was about $65,000 a share. And over the next 15 months, it dropped to $41,600 at the lows. And I remember it well because my largest position every single day it seemed was just going down and down, and astroturf.com and all these crazy internet bubble stocks were just going up and up and up. Finally I said, you know what? Berkshire Hathaway right now is trading below its cash and investments per share. I'm getting all the operating businesses and Warren Buffett for free. And at that point, my fund had grown from its initial $1 million up to about $4 million. And I just said, I'm all in. And I put 30% of my fund into Berkshire. Turns out I got very lucky. It was the day the NASDAQ peaked. In early 2000, it was the day Berkshire Hathaway bottomed, not coincidentally. It was because all the money was pouring out of value into growth and internet stocks at the time. But I got lucky and caught the bottom. And so making a big bet like that in a stock like Berkshire Hathaway, where I had enormous downside protection in the stock could have gone anywhere in the near term. I got lucky on the timing there, but it was an extremely high probability low risk bet. So look for something like that to differentiate yourself. As if you're generally going to run money in a very concentrated fashion, and you're going to take risks, and it's going to be volatile in an effort to outperform the market, you just have to understand a couple things. One, you need to communicate that to your investors so they know what they're getting, and will only allocate you a few percent of their money, their mad money account, right? And secondly, you have to recognize you're not going to attract much of any institutional money with a super concentrated, high volatility strategy. A few people have done it. Bill Ackman's done it for almost his entire career, running an 8-stock portfolio, and he's been very volatile. But generally speaking, the institutional money of the world is looking for lower vol, and that means a more diversified portfolio and tight exposures on the long and the short side, that kind of thing. So that leads me to the second part of that question, Glenn, which
how
is
does an absolute performance manager sell?
So if you're an absolute performance manager, which means over the last 9 years, you've probably been trailing the market pretty much every year, certainly over that cumulative period. Why would anybody invest with you? And the answer is there's a lot of money in the world that is not benchmarked to the S&P 500, that isn't trying to keep up with a pure equity strategy, and is looking for something safer, both lower volatility and then separately safer, meaning that will preserve capital in a down market. So if you can demonstrate that you can do that, maybe only capture 60% of the upside in an up market, but only capture 20% of the downside in a down market, meaning if the market's up 10, you're up 6. If the market's down 10, you're only down 2. If you can crank out those kind of numbers, but you're only up 60% as much as the market in the last 10 years, but you can demonstrate that in the down months, for example, that you're capturing little or none of the downside, you can raise a lot of money behind that, and people will pay hedge fund fees for that.
So we're getting into some of the questions that are a little bit modestly off topic, which we'll address. But for those of you on the line, we're still looking for fundraising questions. Yeah. So here's one that'll hurt. Would it not have been better for you to focus on returns rather than fundraising?
Yes, and that's why I should have hired at least one, if not multiple people, to help with the fundraising. I was never really going after institutional money. So that just meant there was a lot of inquiries from a lot of individual investors. The way we went out and made a name for ourselves was much more in the individual investor space, publishing lots of articles on the Motley Fool and TheStreet.com, being on national television. If anything, those were a great way to attract a lot of inquiries and leads and prospects from individual investors. But a lot of institutional investors don't like that. They like their managers to be completely off the radar screen and unknown. So yes, the primary reason for my fund's poor performance during this long bull market, which eventually led me to close it, was that I was trailing the market after almost a dozen years of consistently beating the market. I was consistently trailing the market. And I think part of that, a small part of it, was just an unfavorable environment for a conservative value investor. But I think a significant part of it is that as the business grew, both the fundraising, but all the other aspects of the business as well, we didn't hire a team. And both Glenn and I think, we're starting to spend way too much time, not just on the fundraising process, but on all the other logistics of managing now a much larger business. We had 3 funds, we had 2 hedge funds, we had 2 mutual funds, and we weren't spending as much time as we should have been, just doing what had led to that investment and success and good returns in the early years, which is just focusing, 90% of our time on the investing process and finding cheap stocks.
So along those lines, when one hires analysts, how do you advise managers to pay those analysts? Cash versus equity in the firm? What's the best way to judge their performance? How important is a team in the fundraising process?
Yeah, well, you need a couple teams, actually. You need an analytical team, an investing team. There's a whole nother digression, and we have a slide presentation on the challenges Glenn and I had of 2 people as equals trying to run a fund. Generally, the structure you see in the investment businesses is there's one portfolio manager, generally the founder of the firm. Then you might have a chief investment officer and some analysts. You don't need to build out a big team if you're 50 to 100, maybe $200 million. But you probably need a couple people. And then separately, you need a support team, an office admin person, You can outsource now a place that could do your sort of bookkeeping and all. So you don't really need a chief financial officer or even a chief operating officer in-house, though eventually you'll want to get those as you get quite a bit bigger. But you definitely should hire a fundraising person. So, as you grow, let's say from 10 to 50 to 100 million, you probably want to bring in an analyst on the investment side, maybe eventually 2 people. And pretty early on, you want to hire a full-time fundraising person and then an office manager admin person. Those would sort of be the first 3 hires. As for how you pay them, the answer is it depends. You're probably not going to be, paying, hundreds of thousands of dollars base salary with big bonuses. That's what the multi-billion-dollar hedge funds are paying analysts. You can get creative, and I can't tell you how many hundreds of people have offered to work for me for free in exchange for some mentoring and so forth. I almost never took folks up on that offer because it wasn't so much the money, it was just my time. You generally want to pay people, but you don't have to pay a lot, and you can sort of share the upside. If the firm is successful, you'll be generous in sharing that. So, it's a lot of people, a lot of talented people are looking to get their toehold in this business. And if you're willing to give them a little bit of experience, a little bit of time and mentoring, they're willing to work for fairly low cash comp up front is what I found.
So, looking back on your investing career, would you have focused on individual investors or institutions in retrospect? Did you ever go after the emerging manager kind of programs?
Yeah, we never had any institutional money. We did have a few family offices. The transition normally is you start with friends and family, and then you just work the networks, word of mouth, try and make a name for yourself, just out there hustling, getting individual investors. That might be your first 10 or 20 million, maybe even above that. That was almost my entire investment base up to 200 million. Then you want to think about real high net worth individuals and family offices, and only when you're quite a bit larger, certainly well over 100 million, do you even want to think about going after institutional investors who are going to be looking for a lot of the bells and whistles of fancy offices and a fully built out infrastructure, that kind of thing. There are some institutions that like to invest with emerging managers. Some of the good prime brokerages have cap intro efforts and conferences. I encourage anyone starting out to just go hustle and show up and meet as many people, try and get your name out there in any way possible. Keeping in mind, though, you can't lose focus on the investment process. If your returns are no good, you're wasting your time. You're never going to raise a dime. You got to go out and put up some decent returns, to break above a few $1 million from your immediate friends and family.
So in our programs, where the 1-day programs and the 3-day programs, we are very, very open and upfront and answer any question that gets thrown at us. And as a example of that, how would you feel now if you indeed did get to much higher AUMs, but delivered the performance that you did in the last 9 years?
Yeah. So look, I would feel lousy if my poor returns had been on a larger base of capital with more investors. What I'd like to think is that had I built my business correctly, we would have avoided the poor returns, because part of the reason for the poor returns, I think a major part of the reasons is just Glenn and I getting spread too thin. We tried to do it all ourselves. We were sort of bootstrap entrepreneurs. We're both cheapskate value guys. And we did not invest properly in the business. So anyone who is successful in this business is, by definition, if you grow your assets, you're going to have a lot more investors. And just managing 200 investors, not 20 investors, is a huge time sink, not to mention the whole fundraising process of going out and attracting more investors. Generally, when you're managing $200 million, you probably own a few more stocks than you did when you were managing $20 million, or certainly $2 million. So you need to have you need to build out an investment team as well. So when I look back at the mistakes on the investing side that led to the poor performance, I think had we built a team on the investing side and on the operations support fundraising side, and successfully made the transition that every successful manager has to make, which is when you're actually running a good sized business, you're not going to be able to spend 90% of your time just reading annual reports and finding cheap stocks. There's almost no one who's grown to any scale that's been able to do that. So your role changes. You become you still have to keep control of the portfolio and the big decisions about what goes in the portfolio, how it's sized. Never give up control of your portfolio. But you're going to transition from spending less time, diving into the weeds on every individual stock, and more time managing people, being an entrepreneur, building a firm, and also very importantly managing risk in the portfolio. And so, had we raised more money, I think we would have had more of a management fee stream. I'd like to think we would have been smart enough to have invested in building out the infrastructure, which, by the way, we are in the process of doing. We're sort of right when we peaked at $200 million, but we should have done it a year or two earlier, and I think we could have avoided some of the poor performance afterward. I'd like to think that anyway.
So this next question, I'm not sure that I understand it, so I'm going to ask it so that if you understand it, you can answer it. But if not, I'd like the questioner to elaborate. The question is, how do you see the rebate strategy? How big is too much? Can it be a race to the bottom thing?
I'm not sure what they mean by rebate.
Yeah, I'm not sure which rebate they're referring to. So
is it soft dollars?
I don't know. So that's maybe why we can have it amplified.
Yeah.
In the meantime,
whoever asked the question about rebate, if you just want to shoot on the chat or the Q&A and specify what you mean by rebate and whether that's whether you're referring to soft dollars, we can come back to that question.
It seemed like Buffett's partners were mostly individual families rather than institutions. Does it still make sense to try and build a fund based on this source of capital?
Yes, absolutely. In fact, I don't think you have much choice. If you are not coming out of a multi-billion-dollar fund, spinning out as a tiger cub or a tiger cub, if you don't have that kind of institutional pedigree with a large firm, so now we're talking 99% of the startups, people getting into this business, 99% do not have that pedigree. It's just a handful of people coming out of the big shops that can attract institutional money and start with a few $100 million and a whole investment team built out from the get-go. So you have no choice. No institution is going to give you money. If you want to raise money, it's individual investors. So you start with friends and family, and that's how Buffett built his entire Buffett partnership. And I remember one of my investors was one of the original Buffett partnership investors. He somehow heard about Buffett, this young kid in Omaha, and this guy lived in Tulsa. And he wrote a letter to Buffett. Buffett wrote him back, and he wrote a letter to Buffett saying, "I've heard good things about you. If your travels ever bring you to Tulsa, I'd love to host you and meet you, and I might invest and might introduce you to some of my friends who might be interested in investing as well." And Buffett wrote back, within a day or two of receiving the letter, and said, "I'd be happy to come to Tulsa." He hopped in his car, he drove to Tulsa, he sat in this guy's living room. There were 12 people, and 3 of them invested. They bought Berkshire Hathaway A shares. They owned Berkshire Hathaway A shares that Buffett bought for the Buffett partnership at an average cost of $12 a share in the early 1960s, to give you an idea of the kind of history here. So that's sort of what you got to do. That's what Buffett did in the early days, and that story hasn't changed. Whether you're starting up an investment fund or doing any kind of entrepreneurial venture, your early source of capital, the people who are willing to stick their neck out and take a risk with you, are your parents, your siblings, your cousins, your in-laws. The 10 of my first investors were section mates of mine at Harvard Business School. It's mining your personal network. And you don't want to be too overt and in people's face about it. But on the other hand, that's you gotta go out there and at least put yourself out there and and ask people to invest. After my parents and my in-laws, so I started with $1.1 million from 3 investors, myself, my parents, and my in-laws. My 4th investor, 3 weeks into launching my fund in 3rd week of January 1999, was Bill Ackman's father. Bill and I have been friends since college days. I knew his family well, and his father wanted to help me out and support me, and wrote a $250,000 check. That was super, super meaningful to me when I was only managing $1.1 million. Meant a lot. So that's, then I accepted a bunch of small $10,000 investors from my business school section mates. And by the way, if you're setting up a C1 fund as opposed to an accredited fund, as opposed to a C7 fund, which is a qualified fund, generally most people start out with a C1 fund. You're limited to 99 investors, and there's certain accreditation tests, but there are exemptions, I think up to 32 exemptions. And you can take in anyone who's not an accredited investor. You can take them in at $10,000 if you want. And that's what I did with quite a few of my Harvard Business School section mates. And while their capital wasn't material at $10,000 a pop, one of them introduced me to her father. Another introduced me to her brother-in-law, both of whom turned into $250,000 investors right out of the box. My single largest investor in my early days was a guy I played pickup basketball with at the 92nd Street Y. And in between games, we would chat, and he was interested in stocks, and I had no idea who he was. One day he said, could you send me your documents? I might be interested in investing with you. And I sort of chuckled and sort of rolled my eyes and said to myself, another $10,000 investor, maybe. And then he called me up a few days later, and he said, I read all your documents. I'd like to invest. And I said, great. How much were you thinking? And he said, 2. And I said, 2 what? And he said, 2 million. And I almost fell over. Turns out he had been at Goldman for 20 years, had nailed the timing just right. Goldman had gone public recently. He cashed out, I would guess, to the tune of $100+ million. I had no idea. He was just a guy I played ball with, right? So that's, you never know. You never know. So you just got to show up and treat everybody well. Try and make a name for yourself. Write smart letters. There's so many ways to get to, you can post ideas on Value Investors Club or Seeking Alpha or Some Zero. You can create your own website and blog. It's now a much more crowded field out there. Back when I started writing for The Motley Fool, it was the early days of the internet. You could probably count on 2 hands the number of people who were out there writing regularly, and not many of them were preaching value and the gospel of Warren Buffett, especially in my first year plus during the peak of the internet bubble. But there's still opportunities out there these days. There's some young guy who goes to the Daily Journal meeting for Charlie Munger's annual meeting every February. And he takes really good notes and publishes them, and they get circulated pretty widely. And that's a good way that young guy's making a name for himself. So there's still opportunities out there.
So in terms of the fundraising, we've got this question based on a number of jurisdictions. Hi, do any of the core principles related to capital raising or starting a firm change material for insert UK, Hong Kong, Japan, versus the United States?
Yeah. So the question is, how does this process differ? If you just go back to the 6 key elements of an effective sales process, those are universal. And by the way, they're mostly not limited to raising money for a hedge fund. They're selling anything. You have to, number one, you have to have confidence in what you're selling, in your product. Number 2, you got to make sure you're structured and you have a support team and a follow-up process, et cetera, to execute on the process. And if that means hiring somebody, great. Number 3, you got to generate a lot of prospects. Number 4, you got to increase the conversion rate, et cetera, et cetera. All of that is true in any fundraising process of any sort. Those foundational principles. Now, where the question, it's a good question, is well, what about the details? And the answer is I don't have a lot of experience, raising money from the royal families in Abu Dhabi, for example, or from billionaire Chinese folks over there. My sense is for most of the people listening on this call, and certainly we're attending our seminars and so forth, are generally people trying to bootstrap it. And maybe starting with a few $1,000,000 and hoping to do what Glenn and I did and, grow that into a real business. Because it's not a real business south of $10 million for sure. And so there you're talking about raising money from individuals. And again, that process is going to be very, very similar in terms of, trying to make a name for yourself and just getting the word out there and mining all of your personal relationships. I think the process does get a little different once you get larger and start going after institutional money. I know there's a difference. European institutions generally want monthly redemption terms. U.S. institutions, you might be able to get away with quarterly or semi-annually, that kind of thing. But that's a high-class problem for anyone to have, because that means you've really hit it and you've grown well beyond your initial base of friends and families, and are probably north of 100 million and up before most institutions will even look at you.
So I want to get back to this rebate question. So you charge 1.520, but you need to pay an intermediary half of that in some cases, and
meaning you've raised money via fund of funds, or not a fund of funds, a third-party marketer. Is
a
that
fund of funds, a third-party marketer, someone in the
Yes.
middle, 50%.
Yes.
And is this a race to the bottom because it's likely hot money?
Yeah. So, and I now understand the question, which is there are plenty of brokers, agents, third-party marketers that are out there that have a Rolodex. If they think you're great, will go out and effectively sell for you in exchange for a percentage of the economics. The questioner is saying, they want 50% of the economics. That sounds at the very high end to me. Typically I see something more like 20% of your economics, meaning they get a percentage of the management fee and the promote, sometimes just the promote. You keep the entire management fee to yourself, but as long as if they bring money into your fund and you're charging a 20% promote on that, they get 20% of your 20% for as long as that money is in the fund. That's a pretty standard arrangement. Generally speaking, it's an area I would say we had no direct experience with that, but we had actually just signed a third-party marketing agreement with a longtime investor and good friend of mine. So somebody I knew and trusted. He wasn't going to bring hot money into the fund, et cetera. And unfortunately, that's right about the time our returns sort of went south, and it never went anywhere. But we were happy to pay that. But you just got to be super careful. There are a lot of charlatans and shysters out there. Generally speaking, putting an intermediary between you and the investor is going to result in much hotter money. And I can tell you some stories of people who sort of went that route. And a couple $100 million flowed in very quickly. And then they had one down quarter and all the money flowed back out. And they were forced to sell a lot of stocks. And it was very disruptive to the business. So my general caution, my general advice is be very cautious. If you can build it directly by hiring somebody in-house where you own that relationship, and paying somebody in-house who maybe has a Rolodex, and they get a very nice bonus for bringing capital in as part of their job. I think that's a preferable way to do it. And that's the way most funds do it.
Warren Buffett never used analysts. Why should we choose to have a team instead of going it alone?
Mm-hmm. It's a good question. Well, look, first of all, you're not Warren Buffett, and I'm not Warren Buffett. And he, in many ways, was very just a unique individual who is able to get away with it, but most mere mortals can't. As he grew, also keep in mind his Buffett partnership, Glenn, probably never went above 100 million, is my guess. He managed it out of his bedroom for 10, 12 years in Omaha. And he never got distracted with anything. He just ran a super concentrated book. And so basically, nothing changed for him as he grew from a few $1 million to $100 million. And then keep in mind what he did is he closed down his Buffett partnership, and his investment vehicle became Berkshire Hathaway. So at that point, he did not have limited partners that needed care and feeding. He was not out there hustling to raise money. He did not have to deal with investors who redeemed or anything like that. And frankly, he just never had a down period. He's one of the few investors ever whose Berkshire Hathaway stock has had some declines. It's had, I think, 50% declines in the last 40 years or so since Buffett's been running it. But his performance has actually been pretty remarkable. So he's never had to weather the investor angst of underperformance. I guess the worst I ever saw it was back at the annual meeting in 2000, which is right about as the internet bubble peaked. And, he was getting all sorts of questions from shareholders who were like, why haven't you bought astroturf.com? Berkshire Hathaway stock is down, 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 and all my internet stocks are up, up, up. But in other words, nobody could redeem from him. He wasn't running a partnership. He could just shrug his shoulders and said, this is crazy, and I'm just going to stick to my knitting. So Buffett has done a lot of, is a clear outlier in many, many ways. In your early days, when you're up to 10 or 15 or $20 million, you don't have a choice. You're going to have to do it all yourself anyway. And being super efficient with your time is going to be very important. But don't kid yourself that you're the next Buffett and can just continue doing it on your own. Glenn and I tried to do that, and we paid the price. And it's hard for me to think. I can think of a few examples, but out of 1,000 funds I've looked at over 20 years, I can only think of a handful where they successfully scaled, north of $100 million and didn't need to bring in at least some infrastructure. Now, that might only be 2, 3, 4 people, but Glenn and I tried to do it up to $200 million with nobody else, basically, other than a secretary/office manager.
I'm not sure I understand this question, but perhaps you'll understand it better. Monish Pabrai has suggested to starting and marketing a fund only on shameless cloning of stock ideas. Do you think this is actually possible?
Is the question that is claiming that that's what Monish has done, or is it that's the advice Monish is giving?
Well, we both know that's not what Monish does.
Right. So Monish, by the way, speaking of a handful of examples of people who have successfully grown their business and not really hired an investment team at all, Monish is one of the few examples. I think he's running $700 million or something today. And he doesn't have an analyst. And I think he has 1 or 2 support people and takes a nap every afternoon. And it's a beautiful business model. He's done extraordinarily well. He's a good friend, and I'm an admirer. But I think he's a bit of an outlier. He's one of the handful of exceptions I can think of.
But as far as starting a business based on cloning, retread ideas, I think that's a very bad idea.
Yeah. The problem is in today's world of so many ideas being published on places like SumZero and Seeking Alpha, and my favorite is Value Investors Club, it's hard to have an original idea that somebody hasn't pitched somewhere. So I think you really sort of have to be agnostic you don't want to have the not invented here syndrome. If it's a great idea and you happen to read about it on Value Investors Club, or a friend of yours happened to pitch it to you, or you were reviewing 13F filings of very smart investors, and you noticed that someone you really admired just took a big position in a particular stock. Hey, maybe I should take a look at that as well. It's a perfectly sensible thing to do. But you should never just go in and blindly follow anybody into any position. You need to do the work. It needs to be within your circle of competence. But I had no problem with finding ideas that were initially I got because they were somebody else's best idea. Your challenge as an investor, though, is to filter among the hundreds and hundreds of ideas you see every month. And you only need to find a very small handful of ideas per year to run a very successful business and generate great returns. So that's the challenge. It's like drinking from a fire hose right now. It's the exact opposite of when Glenn and I started in this business 20 years ago, where finding a good investment idea was really value added. And I remember when Outstanding Investor Digest would come in the mail, I'd drop everything to read 50 or 60 pages of some interviews with smart investors like Bill Nygren. And so we would have these little idea breakfasts or meetings with other smart investors to try and share some good ideas. And that was a big part of the value add proposition of generating good returns. Today, the challenge is exactly the opposite. We're all drowning in well-articulated, well-researched ideas that are posted out there. And the question is how to quickly filter through them so you don't become overwhelmed by them and can instead, focus your attention on the ones that are the best ideas that you're most likely to act on once you do all of your own work.
So we just got in a question. What has made Bill Ackman so successful in the early days for him? How did he scale so fast? Was his time spent on investing, or is he just a great marketer?
I've known Bill since we went to college in the late 1980s. We've been close friends ever since. And I think he is one of the best investors out there. And if you were to give people a test, hand them 10 annual reports of any company and ask him to analyze them. Obviously he has his sweet spots in certain areas, but he's just an incredible business analyst, and he has investment insights that have really been exceptional over the years. So he grew because he put up north of 20% a year compounded annual numbers for about a decade. And had a very differentiated, almost unique investment strategy of activism at a large scale, targeting some of the largest companies in the world, from Canadian Pacific to Procter & Gamble and the like. So he built his business based on outstanding returns, a differentiated strategy, a brilliant investor who built out a very strong and talented team. So he did it right in every way. So that's how he grew. It's a separate question about sort of what's happened recently in the last few years, where his returns have really been poor. And is he going to be successfully able to turn that around? And Bill has risen from the ashes before. He was forced to close his first fund and came back much, much bigger and better than ever. So Bill's an extremely resilient person, extremely optimistic person. And I think, there's a saying that there are only two kinds of companies out there: those that are experiencing troubles, or those that are going to experience troubles. And I think that's true of almost all investors as well. So which would you rather invest with? Almost all investors flock to the investors who've never experienced any troubles, but that just means it's going to happen to them at some point, right? Personally, I'd rather find people who've gone through some tough times, who've learned some lessons the hard way, because almost all of us seem to have to do that, and who are going to be better investors going forward.
What are the best strategies to select and work with a marketing person and or third-party marketer? Begin with a trial engagement of 6 months, ? What about economics?
Yeah. Again, we only worked with one third-party marketer, and quite briefly, so I'm not the world expert on this. But generally, ideally, find someone like we found, someone who was a good friend and longtime investor with me, who understood what we were about in our strategy and wasn't going to go out and raise us a lot of hot money. And I think we were going to give them 20% of the economics. I'd be cautious here. If you really want to put the metal to the metal and grow very rapidly, Sam Madrangi chose that route when he was really cranking it at Kerrisdale. I think he told me he engaged with multiple third-party marketing firms, and he had monthly redemption terms, again, super friendly to investors. And he managed the fund accordingly. So when he hit a rough patch and got a lot of redemptions very quickly, he was able to meet those redemptions. So just make sure, one piece of business advice is is whatever your redemption terms are, make sure your portfolio liquidity matches up with those redemption terms, because you never know what's going to happen and when you could get a sudden rush on from investors who redeem, and you do not ever want to gate investors. A lot of funds did that in 2008 because they got caught swimming naked when the tide went out, and that's the kind of thing that usually puts you out of business.
So I think this is our last question.
All right, last question.
What is your view of GP equity interests for a seed investor providing a working capital runway for the management of the company?
Yeah, it's a great question. I'm going to address the sort of broader question about, if you're out there looking to start or you're in your early stages, should you take a seed deal at all? What are the characteristics of what a good deal would look like? And what might the economics be? Because there are a lot of other characteristics beyond the economics. So my general view is if somebody's willing to seed you with a nice chunk of LP capital, a few $1 million, depending on how big your fund is, they're assuming you're not coming out of a big shop, so you're not looking at $50 or $100 million seed deals. Someone who's willing to put up capital and make a venture capital high risk bet on you, generally speaking, that's a great thing. And if someone's willing to help you get to scale and take some of your risk off the table, I'd strongly encourage you to pursue it. That said, be very careful who you're doing business with. Ideally, it's someone you've known for a while, and you can go out and check their reputation and track record. Who you do a deal with is much more important than the terms of the deal, in my view. So in terms of the terms of the deal, are they writing a check to put money in the bank so that you can pay your expenses and you cover your living expenses and so forth? Or are they just putting LP money in? And then what are the lockup terms would be another key term. Ideally, you want a multi-year lockup on that money. And then what are the economics? And are they taking a revenue share or a piece of the profits? And are there any buyout provisions or are there any sunset provisions? So a typical seed deal is sometimes 20 for 20, meaning they take 20% of your GP economics in exchange for $20 million, maybe locked up for 3 years. This is something we teach in some depth during the seminar, where we have examples of 6 or 7 different seed deals, more on the institutional side. So it's definitely it's a great question. It's something, if you think you can get someone to seed you, if there's any indication of interest out there, I strongly encourage you to pursue it. But again, just be super careful. That's true of taking in early equity money from any investor for any business. You want someone, you should be willing to give much better terms and much more of the economics to someone who has a great brand name and reputation, who's going to be a trusted mentor and advisor, who might sit on your advisory board, who can introduce you to other investors, et cetera, versus, your typical institutional, hot money kind of thing. And with that, let me just leave you with one thought, which is putting together an advisory board. And I thought Bill Ackman did something very smart when he started his current fund 10 plus years ago. Pershing Square, he recruited 5 of his most trusted advisors and gave them each 1% of the GP of his business. And it was an advisory board. He meets with them quarterly. Particularly when you're a one-person operation, and virtually all funds, even when they build out the team, are fundamentally one person's making the decisions at the end of the day. And that's the way it should be. Having not only a good team that can push back and tell you if they think you're making a mistake, but also separately from that, an advisory board of people who own a piece of the GP because you've given them a small piece of the GP, but hopefully have some LP money in as well. So they're partners just like everybody else. That's something, again, I'd strongly encourage, something I never did and I wish I had. So with that, I think we're going to wrap up. It's been about 90 minutes. Thank you for those of you who dialed in. We've made it. This webinar has been recorded, so I will send everyone who registered, whether or not you were on the call today, a copy of the video. We're going to make that available publicly on our Kase Learning YouTube site, and we'll also send out a copy of the slides that we presented. And if you're in the process of early stage looking to grow a fund or are thinking of doing so at some point, what we've talked about here in the last 90 minutes is 10 or 20% of what we teach over an entire day. Really diving into the weeds of the decision whether you should start your own fund is a critical one, perhaps the most important one. Then the logistics of how do you pick a prime broker and negotiate a good deal with prime brokers? What are some of the legal aspects? What should your redemption terms be? We've already talked a bit today about management fees. When should you hire people? At what stage and who should you hire? And all of the things related to actually starting a business. And then the second half of the day is how do you build that business? Most importantly, how do you raise money? And trust me, we've only scratched the surface of all the lessons and wisdom we can impart related to that. We, in the course of our seminar, we go through some actual investor presentations, including our own, and highlight the strengths and weaknesses and things that you probably want to adopt in your investor presentation. We go through 6 or 8 investor letters in terms of how you should communicate with your investors. So there's a whole bunch of stuff that's really, really important. That's worth spending a day of your time, in my view, with us. And so we can impart two decades of experiences, wisdom, and help you both achieve the success that we did, but also avoid the mistakes and avoid getting the scars on our back that we also did. So with that, feel free to reach out to us. Our website is kaselearning.com, and we hope to see you tomorrow at our webinar on short selling. So thanks again for joining us. Good night.